Is there any reason to be bullish? Joining us now is Kaeppel, Senior Research Analyst over at Sentimentrader. Jay, you got some models for this.
Good
Do I
morning.
want to be bullish
Yeah.
here?
Well, as a matter of fact, the indicators that I follow are actually net bearish, so I'm not fully invested at the moment, but I do have a reason for optimism. So one of the best indicators I have come across involves new highs and new lows on the NASDAQ index. And when new lows overwhelm new highs completely, as it has done recently, it typically happens near capitulation, not necessarily at the bottom, but very close. So the model that I follow, it's given 9 signals since 1990. The most recent one occurred last Thursday, May 12th. The previous 8 signals all saw the NASDAQ rise in the next 12 months. In fact, the average gain was over 40%. Now, that doesn't mean that's going to happen this time. It certainly sounds very optimistic at the moment, but it is definitely something I'm keeping an eye on. Given all the negativity, it's perfect. And it's one of those indicators, as the old saying goes, when the time comes to buy, you won't want to. And I think that applies right here. So I'm keeping a close eye on that. One thing to keep in mind, though, historically, the previous 8 signals, the average number of days between the signal and the actual bottom is about 6 to 11 trading days. So that's about a week or so, a week or two, up to a month. And the average decline from the time of the signal until the actual low the average is about 6 to 8%. So picture a scenario where about a week from now, the NASDAQ is 6 to 8% lower. Imagine the fear and panic that's going to be going on in the market at that point. And yes, I absolutely think that if that unfolds that way, would set up a terrific buying opportunity. So it's not necessarily a reason to be bullish at the moment, but something to keep an eye on.
When we get there, if we get there, what do I want to buy?
Okay, so the big problems right now in the market, everybody knows them: inflation, rising interest rates, and poor price action. So we did a study at Sentimentrader, and we looked at when inflation is high, as it is today, and when interest rates are rising, as they are today. And when those two factors are in play, since 1926, the top 3 sectors have been energy, healthcare, and consumer staples. Okay, so this year, energy has been terrific. It's up, XLE is up over 47% for the year. The other 2, XLV and XLP, are both down about 9%, which isn't good, but it's better than the minus 18% for the S&P. And by trading those 3 together, your return for the year so far is a little over 10%. And I think a lot of people would be pretty happy about that right now.
Yeah, absolutely, Jay. Well, but let me get in here because I feel like one thing that may make this time different, and I say that with some air quotes, is what we've seen with the retail investor over the last 2 years. And I'm wondering how that kind of flow and sentiment plays into these models.
They don't. They don't. They're standalone models. We look at, that's what we do. We're a research firm. We look at data, and basically all we're looking for is ways to find an edge in the market. And we're not necessarily looking at even the current environment to say, well, what might happen here? In other words, we don't try to predict. We try to find the question that we tell people to answer is not, what do we think the market's going to do next? The question really for any investor is, how are you going to allocate your capital? Because that is really what's going to decide your fate. So just to follow up on that, at the moment, if I may, the model that I follow right now is 30% in cash, which is very boring, and it's not making much, although it could make more as interest rates rise. And it's certainly better than minus 18% on the S&P. Plus, I do have some capital available if the scenario that I talked about before unfolds. So the second part is 20% in commodities, okay, which have done phenomenal this year. They're probably due for a pullback. But I did a study a while back, and based on reversion to the mean, it would not be surprising to see commodities continue to outperform stocks for the next 2 to 3 to 5 years.
Wow.
And then if we get a bounce off the lows, we touched on the equity. So let's talk about the duration of any rally when we see it.
Sure.
Bottoms tend to form quickly and bounces tend to happen fast.
Right.
How long a kind of scenario are we looking at here? Is this we bounce into the fall later on this year, summer looks good? Kind of how short and sharp is this going to be, or is it going to be something that you're going to be able to trade into?
Well, as I mentioned before, if I just focus on the indicator, the new high, new low indicator that I talked about before, the follow-up rallies have been terrific. The last signal was in the late part of March 2020. And I mentioned before about how when the signal comes, you won't want to use it. Well, that was perfect, right in the heart of the pandemic. The previous signal was Christmas Eve of 2018, was followed by 3 of the most awful days that anybody's seen leading up to Christmas Eve in 2018. Had a terrific rally. So once it starts, the thing that I'm finding is sentiment is getting very, very overdone to the downside. And everybody seems to acknowledge that. But the one thing we haven't really had yet, I keep saying this, we have fear, we have doubt, we have angst, but we don't have capitulation. We don't have people dumping stocks yet. Well, and I think that it probably will grow.
We only just have about 45 seconds left, but at a VIX at 28, what does it need to be to show capitulation?
I'm sorry, what was the question?
If the VIX is at 28 and we see capitulation, what does it need to be?
I tweeted out yesterday, I said, wake me when it hits 45. Because if you look at history, all the big declines, it spikes to 40 or 45. So yeah, the 30 isn't going to do it.